Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today, I'm with Mike Davis. How you doing today, Mike?
I'm fantastic, Kirk. Thanks for having me on the show.
Yeah, thanks for coming on. Glad to have you here. So, this is an interesting topic. It to me is a lot of interesting things about this topic, but I wanted to bring Mike on to talk. So, Mike, why don't you tell us a little bit about your background?
Sure. Yeah. I guess I would describe it as I'm a consultant turned operator and now investor. And I really am I'm passionate about supporting women and immigrants.
Okay, so how did you get? So, tell listeners a little bit about what you do.
Well, I run an outfit called Olive Tree Ridge, and we are an asset management firm and an investment bank. On the asset management side, we have a few strategies, venture, and then we have a private equity strategy. And then on the investment banking side, it's really helping women and immigrants access capital markets, both debt and equity markets. So helping them raise the right type of capital to help them grow their businesses.
So, how'd you get started down this road? Like, what took you here? What caused you to say, "Wow, this is the route. This is the road I want to go down"?
Well, it was a route that was very clear and was predetermined, and all I had to do was take one step after another. Not, I'm being facetious. No, it's a very circuitous route with a lot of lived experience. I started out my career in consulting, helping clients sort of think about and tackle their big major initially technology issues that they were facing and turning those issues into opportunities. And then I started the first of what became many businesses. And over time, I just got more and more kind of focused in on the things that I'm passionate about, and the way that I think about my businesses is sort of like before business school and after business school. Before business school, my businesses were all service companies where the levers were very straightforward, the margins were rather straightforward, and then I got into products after business school. The other thing that changed after business school is I started companies with co-founders, initially with classmates of mine. I attended INSEAD, which is a business school in France and Singapore, with the campus also in Abu Dhabi and a presence in San Francisco as well. And there I met some incredible people, and so started businesses with co-founders that were initially classmates of mine. And what got me into capital markets was my most recent project before Olive Tree Ridge was Empower Financing, where we created a business to finance international students coming to North America to study at top tier schools. Banks do not lend to this population. It's not very easy to get an educational loan. And there was a mispricing in the market. That's what we felt. So we started that business. And you cannot be in the lending business and self-finance, right? You very quickly realize you need outside capital, both equity and debt capital. And for the first time ever, I switched from being the chief technology officer of the companies that I started to the chief investment officer. And then I started learning about capital markets, what it takes to raise capital. And it is quite arduous, right? It is very complicated. And it is, I describe it as the perfect intersection of math and relationships. And so I would, let's see, 2019 was the last time that I was involved with Empower Financing. I transitioned off the board and I started Olive Tree Ridge. And there I said, this problem exists for numerous founders, right? Especially women, especially immigrants, those who maybe don't have the sort of network necessary to help them learn, help them navigate capital markets. So we started the investment bank and we started the asset management business. And so we are now very squarely in investing and backing, the female and immigrant population as they grow their businesses. That's really the kind of backstory.
Now, why do you think there's a disconnect in those markets? I mean, there has been for a long time, but why do you think that disconnect exists?
Yeah, the stats kind of speak for themselves, and rather than regurgitating those stats, right, I think it's more interesting to get sort of the lived experience view on this, right? So I myself am an immigrant to the US. And I can tell you that as an immigrant to the US, you have a very sort of theoretical understanding of what it takes to be successful in America, right? The land of opportunity, that white picket fence, the 2.3 kids, right? That's like the theoretical understanding of the American dream and the pursuit thereof. But it's much more nuanced than that, and I think part of that disconnect is understanding the nuance. When you take an opportunity to market, how do you do so effectively, right? And that requires, um, frankly, lived experience. You have to have gone through it to understand what works and what doesn't work. There's a lot of material online that folks read, and that's a great place to start. But really, sort of having a mentor, having a guide, having a advisor to help you through that process is how I got started, and the way that we help remove some of these barriers. So we bring our network to help, right, and remove these barriers for others.
Nice, nice. Well, that's good. And one of the things that I know you kind of work with is emerging managers,
Yeah.
and I bring this up because I remember years ago, some of the stuff we do is kind of unique, and I was exploring. I'm like, oh, how can I was trying to explore, like, should we raise a fund? Should we do other things? And I was going down this road, and I was talking to some friends of mine who run like hedge funds and other different funds, and they're explaining to me this process of actually what goes on in the fun world. And I'm like,
Yeah.
God, how does anybody raise any money? Like, this sounds horrible. Like, this just it sounds like, for all the money in Wall Street, it's really not set up in the way that you think it would be to raise capital for good managers. And so can you kind of talk a little bit about that and how that works? Because to me, it's just fascinating. And maybe probably listeners find it fascinating too, about like how it's actually constructed based compared to like what people probably think. Oh, it's easy. You just go out and you just raise money.
Yeah, that's right. And certainly, right, depending on your news source of choice, right, you can you hear all kinds of things about there's a lot of capital sitting on the sidelines, there's a lot of capital waiting to be deployed. And that may or may not be true depending on what your strategy is. But the way I kind of explain funds and the fund world to folks is, there's really kind of three things that you need to think about. One is sort of, what is your product, what is your process, and then sort of what is the outcome that you're hoping for. What's the world going to look like, the sort of passion, if you will. What's the end result going to look like. So if you start with the first one, what's your product? If you think about your thesis, your strategy as a product, right? It's an opportunity for folks to deploy capital in that strategy. So, one example is, I'm going to raise a fund and invest in public equities, right? Okay, that's great, but what is your unique take on that? Why would you be able to attract capital? We'll talk about process in a second, but the idea of, right, what is the product? In our case, our product is backing entrepreneurs in emerging markets with amazing ideas, right? And then bringing our know-how, right? I've been an operator for almost 20 years. So bringing the operating experience alongside capital, are we able to have different outcomes than the norm, right? And inflation and policy rates and things like that also inform that strategy, right? If you think about now, right now, the hurdle has risen, right? The risk-free rate is a lot higher than it was, certainly in 22. And so that further kind of forces this precision, if you will, on what the product is that you're bringing to market. And And so that's the first step, right? The second step is process, right? And this is where emerging fund managers often struggle, is you need to get this product idea in front of an audience, right? How do you find those that have the capacity to invest? How do you have that conversation, right? And the way that I describe it is, it's again, it's math meets relationships. So the kind of table stakes is, you're going to need to be able to explain what it is that you're bringing to market, very similar to how an operator brings a new product to market in a startup, right? This is what our strategy is. This is what we hope to invest in, and here are some examples of deals that we would invest in should we have capital. That's one way. Another way to do it is go ahead and start deploying your own capital, right? And then there's a variety of mechanisms that allow you to attribute that to the fund, and that's not the purpose of this call. But essentially, what you're going to want to do is focus on the process, right? Identify the names, identify the contacts, get in front of those folks, and then see how your idea, how your product is received, right? And so then I liken it to, or the analogy that I draw is the product market fit. The market will speak. If you are able to get those initial meetings and present your product, you will receive feedback, right? And so then it's up to you to determine there is space in the market for this product, and all I need to do is double down on the process. Or you're going to need to change the product, alter the product, pivot the product, and then bring it back out to market. And so that's a little bit of what we help emerging fund managers with. And then there's sort of like, what does the world look like, right? In our case, right, if we are successful, qualified investment professionals who have aspirations to be fund managers have the ability to do so, right? The barriers that exist for them in the market are reduced or eliminated, right? So in the case of emerging fund managers, I already spoke about one of the hurdles, which is, who do you take your product to? Another one is the GP commitment, right? It is well understood that if you want to be a GP in a fund, you need to be able to present 1% of the AUM that you are raising and post that up as part of your commitment to your own fund. And that is, from right or wrong, I mean, we can talk about that, but that also demonstrates skin in the game, right? Like you are aligned with your limited partnerships, limited partner participants and investors. And but when you think about that, how is an emerging fund manager, especially females who have chronically been underpaid, how are they going to be able to post up that 1%? It's extremely difficult. And so there, when you look at it from the Olive Tree Ridge perspective, there's an opportunity to add value, right? There's an opportunity for us to say that is arbitrary, and we can help you with that. If you have a great idea, if you have a great product, if your process is tight and your vision of the world is one that's aligned with ours, then it makes sense to work together. That's how we think about that.
Yeah, that's interesting. I mean, I know that the 1%, what's interesting is I would much rather have somebody who's got 90% of their wealth tied up in the fund than having like a 20% of their funds in there and it's only like 10%, right?
Yep.
And I think it's hard when you're assessing fund managers. I've seen a lot, and you can tell like right away if people are just blowing smoke, or they're just like, oh, I mean, this has been a trend in the last at least 5 years, maybe 6, where people they realized that there's plenty of money out there
Yep.
chasing something, especially when interest rates were 0. And if you could say, oh, I can get you 7%, like, well, I don't care what it is, let's do it, right? It's like,
that's right.
It's like mobile home parks. Oh, 7%, let's take it. I'm like, 7%, that's not enough for mobile home park, but the people would take it because it's the best rate that they could get for cash flow. And so in some ways, I wonder, like, we just went through this big paradigm shift in the last 2 years, and we went from a 0 interest rate environment to a historically normal interest rate environment, but it doesn't feel normal because we've had 0% for so long. How does this impact the different markets you're dealing with? And, just let's start with the impacts first.
Yeah, well, so I love the way you phrased it, historically normal, right? Like what is interesting is that, you know, in a lot of people's lifetimes, interest rates are at their all-time high in their lifetime, right? And so, some folks are sitting there thinking, we're going to return back to a zero policy rate. And, if I knew the answer to that with any certainty, I would probably be in a different line of work. But the the reality of the situation is that what if you think about the policy rate in terms of a risk-free rate, if you do nothing, you can have both liquidity and a return that is somewhere in the range of what the policy rate is. And so, how does that inform your product? And so, using your example, yeah, if you're bringing a product to market that is promising 7, well, in a world where risk free is north of 5, right, and will likely be for a while, then, is it compelling? Is those extra 200 bips compelling? Are those 200 bips compelling? I don't know, but that's the that's the decision. That's the sort of like what's in the mind of the person that you're talking to. They have a different issue that they are trying to resolve, which is policy rates directly inform inflation, right? And if they do nothing, right, they are seeing their purchasing power going down by inflation. So if you look at inflation and you look at policy rates and you put the two things together, right? If they don't invest with you in this product, right, they have some options available to them, but there's also some urgency to their deployment, right? They do need to come up with a strategy for their capacity, for their own wealth, right? And so that's sort of one impact, right? It's you know fine tuning the product that you're bringing to market. In our case, in emerging markets, right? I do believe in the power of the emerging markets in terms of both value, present day, and value creation, right? So the upside of that, right? We invest very heavily in Africa, LATAM, and if you look at LATAM, for example, right? The fractionalization of consumer products is something that, especially in fintech, right, financial products, is something that is quite nascent. And what does that mean? That means that the minimum dollar amount required to invest in some of these instruments is quite high. And if you are able to fractionalize that, more folks are going to be able to participate and benefit from the wealth creation opportunities. That right there is the beginnings of a product you could bring to market. Now, we don't stop there, right? We look at the cross geographical kind of portability of these ideas as well. There is a reason why we're focused on these two regions. And in those two regions, not all the countries in those regions, right? Contrary to popular belief, there are more than Africa is not a country. There are more than 5 countries in Africa, and they are not all the same. So, the other way that this informs our product and informs the way that we staff our fund, the way that we think about our extended network is boots on the ground, expertise with lived experience in these regions. And so putting that together, packaging that up as a product is something that we've been doing for years and something that we are, again, quite passionate about. I didn't talk about that third bucket there, about what the view of the world is if we are successful. One aspect of it is there are more fund managers doing this work. Again, the statistics speak for themselves about the returns that first-time fund managers post up versus folks with repeat funds or consecutive funds. And then, so that's one aspect. But think about if more folks in the world had the opportunity to participate in their own financial systems, in their own agricultural, flows, right? How could we benefit? How could we improve things like food shortage? And so there's a reason why we focus on the geographies, and then furthermore the sectors that we focus in: health tech, ag tech, fintech. Um, just to name a few. So that's kind of the impact that things like inflation, things like policy rate have. One other thing that is, not talked about or not represented in, CPI or inflation and policy rates is value, right? You saw we're coming off of a period where it was crazy making, right? These valuations that folks were able to raise at, especially domestic, right? US startups. Forget about the coastal effects, right? But these valuations climbing and climbing and climbing. I think there's a kind of return to some type of sanity, but we focus on value, right? In LATAM and in Africa, there are still pockets of value where the valuations are reasonable. The growth trajectories that these companies would need to achieve are also reasonable and something that we can help them achieve, right? Again, that value added services part of being in venture, being in private equity.
Yeah, so let's talk a little bit about there's a good perspective on kind of the world here, but let's talk a little bit about, well, a few different things. So
Okay.
private equity space, right? It's been years, and I remember back in 17, and there was I forget the year this started. I don't know if it was 15 or 17, but there's somewhere in there where private equity got hot. Everyone wanted private equity. Everyone wanted to do it. I remember back in the late 90s and early 2000s when hedge funds were catching on and people were like, oh, I need to be in a hedge fund. And it didn't matter what the fund was. Like, I'm in a hedge fund. I'm cool. Like, I'm rich. I'm in a hedge fund. And Wall Street saw that and they're like, all right, we'll give you a hedge fund.
Yeah.
Let me give you something that you can buy. And
Yeah.
so they stacked funds of funds of funds and funds. And it's like, well, I only got 3%, but the fund manager actually got 30. Like, why did I only get 3? Well, because Wall Street knew you wanted it that badly. And
Hmm.
so I've gotten the feeling well, I get the feeling, I think it's true, but private equity's kind of gone through the same cycle where everyone's like, oh, I want to be in private equity. It's the place to be. And colleges are there and this and that. And yeah, I only have $1 million, but I want to put a bunch of money in private equity. And it's like, should you? Like,
Yeah.
so can you talk a little bit about the state of private equity now? Because I know it's kind of going through the other side of that curve. And
Yeah.
I'm curious in your perspective on private equity.
Well, I think first it's noteworthy that not all private equity strategies are the same, and they're all, there's certainly the different strategies will be impacted across the spectrum. Where we focus is majority control buyouts of founder-led businesses, and with very specific criteria. In that narrow sliver of what we look at, and extremely narrow. Let me just put that out there, right? There has been some pretty significant shifts, and the first one is, this sort of blind pool um, belief, right, that the manager is going to be able to find deals of a certain kind of shape and size, uniformity in those deals. That is somewhat, let's just say, altered, right? You're going to need to show up with deals, and that's why I led that the previous segment with, you're going to need to put some of your own capital to work, show your deal flow, show the transactions that you've done, and then show the uniformity of your deal flow. How are you getting these deals, and how do you sort of ensure that, or kind of transfer, or communicate that you have some reasonable expectation of future deals looking or being similarly shaped to these deals that you're presenting today. Nobody knows the future, but one of the things that has changed is you know, showing up to the table with more than just an idea. You got to have some, either deals in the works, transactions you consummated, and deal flow, and unique deal flow at that. If they're able to get a look at a deal through other funds, they're going to do so, right? And so that's one thing that has shifted. Another thing that has shifted in the positive is, with let's go back to your mobile home example, right? Like, in a world where risk-free rate is 5% and there are some opportunities that yield 7, right? You maybe not want to get involved in that trade, but you are interested in putting capital to work. That puts additional pressure on the investment manager. The precision of the work that you do, the deal work that you do, to see, like, what is the expected yield of this particular investment. And if you do that on a per investment basis, then it rolls up to what's the IRR expectations of the fund, right? That there's a lot of operating know-how, and let's say confidence in the manager's operating abilities, that has shifted from probably before it was, you were able to kind of, to some extent, financially engineer the returns that you want, put on different capital, put on different types of capital, different turns of debt on the portfolio business itself. But frankly, nothing nothing produces results like actual operating excellence. How do you actually expand margins? Putting on debt, and especially like excessive debt, actually compresses margins. And the investors, I think they're kind of wise to that, and it's very actually satisfying to see, right, that you're dealing with a much more sophisticated investor base. And at least for us, right, we enjoy that because it kind of gives us credit for the deal work that we do, the operating know-how we bring to the table. So those are two examples of how private equity have changed in, again, that narrow sliver of control buyouts that we do.
Okay, that makes sense. Now, are you seeing a lot of rotation going on for GP stakes right now? Because I've been looking at the market and I always get a good sense of what's going on, because when people are calling me, it means that there's some stuff they want to dump on the Rube advisors to dump on their clients. So when they've got plenty of money getting shelled at them, they never call me. Like, my phone is quiet. But when I know when the phone picks up, I'm like, ooh, I got to pay attention to this. It's like a marker for me because I see it a lot. So are you seeing that right now? Like, it seems to be kind of like a bit of a tricky area to be in the GP.
Yeah, I'm chuckling as you're talking, because that is the very first question that we ask, both when we get those phone calls and also internally, like, why are they calling me, right? And you are wise beyond your years, Kirk. Like, if you're getting the phone call, it means that a whole bunch of other people either got the phone call before you, or, right, there's a new list and you're top on that list. You might not want to even be on that list.
I don't want to be on
right?
that list.
But you're getting that call for a reason. And that sort of cautious, or let's say, insights, in self-aware insights, is very beneficial, I would say. Think about that. Why are you getting the call? And you're right, it's sort of counterintuitive. You're getting the call because it's actually tougher out there than than others would like you to believe. It is rough out there, right? Let's be very clear here, right? There is capital sitting on the sideline. That statement is true, but it's not a free flow of capital to any idea that is out there, right? Family offices, single family and multifamily, it doesn't matter. Family offices are staffed with very smart people, right? They are, you're dealing with a very sophisticated, intelligent audience. And so the reason why I say it's beneficial to think this way is because you're kind of getting ahead of the questions that you're going to be asked, right? So making sure you understand why you're getting that phone call, and not so much why you're getting the phone call, but why you would be interested in participating in that opportunity is something that you would benefit from having a very clear answer to, right? Like, we're getting involved because, to use your previous example, because we are experts in the mobile home space, right? That could be the reason you're getting the call, but doubtful, right? Doubtful that that is
Right.
always the case, right? And so, yeah, that would be kind of how I would think about that, right? Why am I getting the phone call? In our case, in Africa and in LATAM, oftentimes we get the phone calls that I enjoy getting are from other investors that we've invested alongside, right? Co-investors. I like getting those calls, right? Because they have, at least the folks in our extended network, they have the same level of precision and sort of diligence that we do, and so then you can kind of get straight to the brass tacks of it. Um, yeah, and also, like, I'd like to add that, like, just because a deal might be hairy or might be cuspy, right? You could still, you know, understand why you would want to participate, but just do so in sort of balance. Take your whole portfolio, take your entire position set into account, right? And maybe there's a small sliver of your exposure that you want in that, you know, a small percentage of your portfolio where you do want that type of exposure. That, you know, that I'm not saying that this is a binary thing, but to be aware of it is very critical.
Yeah. Well, cool. So we're gonna wrap it up here in the interest of time, but I got one final question for you.
Yep.
So in the given where we are in the world and all the shenanigans going on, I'm not going to ask you to predict the future because that would be a fool's errand. But if you had to predict in the emerging space, like where do you think we'll see the opportunities with all the different changes in the former paradigm? Now we're in a new paradigm, and people are still not accustomed to what that looks like. Um,
Yep.
where do you see the opportunities coming in the next 10, 20 years?
You know, for me, it's about the fundamentals, right? Do we have the right people in the right roles making the right decisions? It's the fundamentals, right? What creates value in a business? It's really kind of two things, right? Is the top line growing and is our margins expanding? If yes, then that's a great opportunity to kind of double click into it, right? And, you know, so the way that we put it together and the products that we have in market are focused on the emerging markets, focused on early stage, focused on the operators, and what is the business that they are in, right? Does it help create value for the populations that they are trying to get in front of? If yes, then we're going to double click into it. And then, you know, the second thing is, in addition to capital, right? Money being fungible and all equal, do we have know-how that we can bring to the table to work alongside these operators? And that is itself a loaded question. Do you want to work alongside these operators? Um, and if that's not what you enjoy, if that's not the type of work that you enjoy, then this strategy doesn't work. This product doesn't work for you. But that's where we find the opportunities. There are incredible operators out there doing incredible work in these emerging markets at nice values, not nice value. And that's where we get involved. I think there's opportunity there, certainly for the next decade.
Okay, awesome. Well, Mike, I really appreciate you coming on the show and sharing your wisdom with us. Where can people find more about you?
LinkedIn, I'm on LinkedIn, Olive Tree Ridge. And you can always hit me up on email, mike@olivetreeridge.com.
Awesome. Well, once again, Mike, thanks for coming on the show, sharing your wisdom with us. We'll have you back in the future.
Thank you for having me. Take care now.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. I mean, like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Mike. Really appreciate him coming on the show. Now we're into the panel portion of the show where you have our very own Barb Friedberg. Hey, Barb.
Hi, Kirk. Hi, Megan.
Glad to see you here. And also we have our very own Megan Gorman. Hey, Megan.
Hey, Kirk. Hey, Barb. Good to see you guys.
Yeah, great to have you both here. Well, let's just dive right in. So, Barb, what were some of your takeaways from the interview?
I thought Mike was a really interesting guy. I liked his stories. I liked what he's doing. I don't think any of it is applicable for average investors. Kirk, I think we should talk about things that work for investors or that have more of a potential, things like possibly alternative, not alternative, but different investing strategies and different niches within the markets.
Yeah, we can certainly get to that. Megan, what were some of your takeaways?
Really smart guy, really interesting. I think that he hits on a lot of things about, he said in the beginning of the interview something about like, you have the American dream, but it's really hard to access it. And I think that that's very true. I agree with Barb. We should talk about those topics that she brought up. But one of the things I think it just stuck with me in hearing his interview is that what we don't talk a lot about is making sure you are in compliance financially to make sure that you can function in the US economy. There are so many hurdles: credit, filing your taxes on time, having cash, right? So I think he hit on some of those challenges you see with certain groups of people coming into the country, immigrants who are trying to start a business. So I found that incredibly fascinating.
Yeah, it's an interesting concept because, if you really think about it, the immigrants who come in this country and start a business, and there's a lot of them who do, and they're very successful. Like they work harder than most Americans, right? Like they have a bigger struggle ahead of them because they don't have some of these infrastructures in place that a lot of us do. But in some ways, that's the lifeblood of our economy, right? Is people coming in and working hard, and it's the American dream. Although it does get a little harder nowadays with inflation to have the American dream that it used to be.
Well, and one of the things I saw during pandemic, I did a lot of webinars on PPP, right? The Paycheck Protection Plan. It feels like a distant memory now.
Is that what that meant? I forgot what that stood for. It's been so long.
It feels like a long time ago. And so one of the things that was very striking, I did a lot of webinars for women's groups. And these were women with small businesses, usually solo practitioner. And to get PPP, you had to use your Schedule C to pull certain information from the tax return to apply. And what was very disheartening in the process is that one of the mistakes a lot of people make in setting up businesses, particularly small businesses, is they don't think through things like bookkeeping and being accurate on tax returns. And so a lot of those people who could have gotten access to government funding during that time period were unable to because their Schedule C and their bookkeeping books were just simply not in order. And that's a little heartbreaking when people were trying to keep their businesses alive.
So, and this is actually an interesting issue, and love to see you expand on this, Megan, because most business owners' books are a mess. I mean, I would say 9 times out of 10 when I talk to somebody, like, yeah, my books are a mess. If you're a small business, you can, right? Because it's your business, and you interchange your money with the business money, and it's very common. It's not, there's nothing wrong with it. It's just it's a mess if you try to keep track of it. So, but what really kind of precluded people from getting money? Because a lot of people got money. You didn't even the standards weren't even very high. It was like, take a guess at what your number is and put in a bid for it. And I think
yeah, line 31 of the tax return of the
Yeah.
Schedule C was a negative number. If the number was negative, it precluded you. Now, and you had 2 tax returns to choose from. If I remember correctly, you could use your 2020 or your 2019 tax return.
Yep.
And so a lot of people, think very short-sightedly about like growing a business and what number pulls through to the front page of their 1040. But I think it brings up a point, and I think he was sort of getting to this, is there are certain rules of the road in the United States for having a business, right? And we would call it in the tax world, you need your belt and your suspenders, right? And you think about that, keeps your pants up, right? And I think that's where most people make a mistake going into having a business, is they think they can do it themselves on QuickBooks. And trust me, I go on QuickBooks. I find QuickBooks hard. We have a bookkeeper here who does it for us. And so what I would tell you is getting a bookkeeper, getting the right tax people around you when you're having a business is really important, because there's also opportunities that come on an annual basis and you might not realize it, that can help your business. So again, I think going back to his comment on the interview, it's a hard hurdle accessing the American dream. But being a financially compliant person and having your quote unquote belt and suspenders is really important.
Yeah, I know you raise a good point, Megan, which is getting a bookkeeper to do the work. I think there's definitely some basic skills that that people just generally don't have. And I think bookkeeping solves a lot of that, especially if you're going online and you're trying to figure it out and you've never done this sort of stuff before. I know there's a principle. We just had an interview with somebody recently who talked about this, but the profit first concept, which is like a way that most business owners can at least ballpark some numbers so they don't put themselves into a hole at the end of the year. But it does raise the point of, like, people are out there doing their thing, right? They're running their business. They don't have time to learn how to do bookkeeping. And if you're trying to survive, you're running a business trying to survive, right? In many ways, not, you could be making good money, but you're still running around doing all the business thing and doing the financials is, it's a separate profession. So it's really hard for a lot of people.
It is.
So Barb, when we're looking at some of this, obviously this kind of dips into niches, right? So what Mike was dealing with is, he has a niche. He works with women and immigrants in capital markets, which is obviously a growing need. But it gets into the issue of niche. Like, that's a very specific niche. And I love the fact that he's doing it, because niches are typically where people find good opportunities. So how would you look at this if, for people listening to the show, for investors, like, how should they look at niches? Should they consider this, or what do you think of this?
When we talk about niche investing, what we're really doing is dividing the basic stock, broad-based, diversified stock and bond investing universe, and then adding in more specific slices of that to focus on to hopefully boost your returns. So the core of most portfolios is going to be a diversified U.S. international stock fund, one or more, obviously, that covers the U.S. and the entire world. And then in the bond aspect, you've got a diversified bond fund or individual bonds. But then what if you want to kind of, boost those returns? Look, market returns long-term have been pretty good, 9 to 10 in the stock market, 4 to 5 in the bond market. But let's say you want to try and go for a play or another area that you think might give you either more stability in your portfolio, less volatility, or greater returns. So there's so many ways to go with that. You could learn about options or invest in a fund that trades in options. I know, Kirk, you do a lot of this, predominantly for preservation, a way to keep your capital from dropping too much. Or you might say, I want to go with a tech fund because technology has done so well in the past. And I write for Forbes Advisor, and I do a lot of lists of best type of funds. And in one of my research articles, I was doing best tech ETFs. And after completing that article, choosing about 10 of the best technology related ETFs, over the past probably up to 10 to 15 years, tech funds hit 20 plus average returns on average. And I looked at that and I said, I wish I had known that in the past because I was not invested in a tech fund. Now, does this mean that's going to happen going forward? No, it does not. I mean, and maybe tech funds will underperform. The point is that if you believe there is a sector, be it healthcare, be it senior living REITs, be it technology, be it AI, that's going to outperform, you might want to put a certain amount of your investment capital into that niche with the hope of outperforming the basic stock and bond investment markets.
Yeah, that's good advice, Barb. Megan, what are your thoughts about niching and things of that nature?
Yeah, so I think the first thing is, I think it's interesting, but one of the things that's really important to remember is if you're invested in mutual funds or ETFs, you may already be doing that, right? So one of the things I strongly encourage people to do is use tools like Morningstar to do a deeper dive into the funds that they're already are in. So one of the things I do with clients, usually at the end of the year is I sort of talk about what has been some of our best performers in the market and what has been some of our weaker performers, right? And give them sort of a deeper dive insight, right? So for instance, this year, not a shock based on what Barb said, right? A lot of funds that had very heavy tech exposure did incredibly well, right? And so pointing that out and sort of getting into what actual stock selections in the tech sector drove it gives insight into what's going on in your portfolio. But it's not a guarantee it's going to continue in that sense. And so you may already have certain niches carved out in your portfolio and don't realize it. And why it's important to know that is when everything's doing well, everybody's happy. But if the market is challenged and you're in volatility and you're doing worse than your respective index, you've got to understand why. Being sort of amplified in a certain sector can really burn you a lot of the time. And that's important to think through. I think the other thing when you think about sectors is also think when you're looking in the international and emerging spaces, but think about geographic selection, right? If you are in the emerging market index this year, what you would find is you are 30% China, and China has been down this year in the index. However, there are funds, and I've been working with some of them, where the China exposure is less, but the holdings in China have done well. So think about carving into your portfolio and really seeing where you have more overexposure and underexposure, and think about, is that really where I want to amplify my investing?
Yeah, no, that's really important. So Barb, as we kind of get close to wrapping it up here, what are some final thoughts on this? Because I know you used to be a portfolio manager, and diversification is really important, but we're in this weird economy where diversification doesn't always help you. And, historically it has, but we're getting into a time where it may help a lot less. So how should people be looking at this, and what are some practical takeaways that they can pull from this?
Great question, Kirk. Diversification by its nature means that you're going to have some holdings that stink. And that's just how it goes, because if your portfolio is well diversified, that means some investments are going to go up and then there's going to be those that go down. But the advantage of that is when there is a huge decline in one market, that means you have other sectors or other types of investments that will buoy up your returns and your entire portfolio won't drop in double digits. So in general, it's not a bad idea to include some bonds or bond funds in your portfolio, particularly now as bond returns have come to more normal levels. And I know you and Mike were discussing this, Kirk. We are in a time now with bond returns, 5% short-term bond returns. That's very comfortable. And so people have said the 60-40 portfolio is dead. I don't think so. And even if you're young, you may not want to be in a 90% equity portfolio, because when that stock market does drop 30 or 40% in a year, which it does on occasion, you might want some bonds in that portfolio to kind of hold them up. So bonds, possibly sector investing. Megan recommended Morningstar. Use the Morningstar X-ray tool to help you see into your portfolio. Great advice. I am Barbara Friedberg, and you can find me at Barbara Friedberg Personal Finance.
Great. Thanks for coming on, Barb. Megan, final thoughts from you.
Yeah, I just want to touch on something he brought up in the interview, because he talks about investing with women and immigrants and minorities. And one thing, is often common with endowments and pension funds is if those things are a priority for you, you can build sort of a DEI meter for your portfolio. And think about, are the fund managers you're using, are they women? Are they minorities, right? And try to get a sense of who is actually running the underlying funds that you're using in your portfolio. I know that it's a priority for some people. I know it's not a priority for other people, right? It's a pretty political topic, but it is something that we see pensions and endowment funds do all the time. And it's interesting. It's interesting to see how much progress we still need to make, and actually how much progress has actually been made in the investing world as we have more minority managers run funds. So I'm Megan Gorman. You can find me on Instagram at All the President's Money. Kirk, thanks for having me on.
Thanks for coming on, Megan. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.